the prices of goods and services in the market, as well as exchange rates, ensuring that exchange rates are stable, ensuring that price of goods and services do not rise rapidly. Now, if you look at the target they set for themselves, as indicated above, the authorities are expecting that inflation will drop from over 23% where it is now to 11.9% or roughly 12% by the end of this year. And that would mean that prices of goods and services will start going up, but very slowly. The rate of increase will reduce. Now, once the rate of increase in price of goods and services reduce, the intention of the policymakers or the government is to reduce interest rates on the back of these lower prices, because increase in the price of goods and services is a risk to investments. Now, if the rate of increase is lower now, then the risk is lower. And so the compensation for this risk also would come down, which is interest rate. So another objective of the 2025 budget is to bring down interest rates. Now, how do they seek to do this? If you look at the 2025 budget, the main tool is to ensure fiscal prudence, ensure that there is no excess spendings to the point of over borrowing and putting pressure on prices to go up and putting pressure on interest rates to also go up. So the first thing we noticed was that the government reduced its total expenditure, planned expenditure for this year. Now, that reduction in the planned expenditure, in our view, would lead to a reduction in total demand in the economy. So for instance, let's say you are selling 2 oranges and 20 people approach you to buy 2 oranges or the oranges. There's pressure on you to sell. And so the only way is to increase the price of the oranges. Now, what government is doing by cutting their expenditure is to reduce the number of people that will demand that orange, so that the pressure on the price of oranges will go down. And you find that price pressures will reduce and prices will become more stable. So cutting government spending helps to reduce pressure on prices. Now, but that's just one side of the budget. The other side of the budget is revenue. They need to raise revenue to support any expenditure they want to incur for the year. And you notice that they're expecting revenue to increase this year by almost 20%. But they want to do this without major increases in taxes. Noting very well that increases in taxes tends to be passed on to consumers in the form of higher prices. So once they avoid increasing taxes widely, then they also avoid pressure on prices. Actually, they also propose removal of some taxes. And removing of these taxes will also ensure that the pressure on prices will go down. So already you can see that the agenda in the 2025 budget is geared towards reducing price pressures, making prices become more stable, interest rates to come down. Another way interest rates will come down is if you cut expenditure, as the government is seeking to do, and you try to raise revenue, what you are doing is that you are reducing the gap between revenue and expenditure. Now, we typically, as a country, spend more than our revenue. So that means we normally record what we call a deficit when you spend more than your revenue. Now, if you cut your expenditure and you increase your revenue, you are reducing your deficits. Anytime you spend more than your revenue, that excess spending will be financed using borrowings. So the government deficits, which is now expected to reduce in 2025, means that government would borrow less. Once government borrows less, it means that the pressure they put on interest rates will also come down. Let me quickly just add that all these measures, whilst it will help to restore, or it's expected to help to restore stable prices, can reduce economic growth. But that is just for the short term, because the expectation is that once you restore stable prices, economic growth will bounce back from 2026 and beyond. Now, let me quickly wrap up with our key takeaways from the 2025 budget. First is the deficit that the government intends to run will be financed using Treasury bills. So since 2023, what we noticed was that what the government has been doing has been to finance the deficit 100% using treasury bills. And that's because the bonds market still remains closed. Bonds are investment instruments for investors which mature after 1 year. Now, governments typically would have used that option, but because of the recent defaults that we are all aware of, they now rely on just treasury bills, short term. So in 2025, they'll continue to rely on only treasury bills to finance their deficits. Another thing that we also are inferring from the budget is that the removal of the e-levy will help businesses and individuals retain some of the cash that they would have paid in the form of taxes to meet their objectives of investment or other life goals. So the removal of the e-levy frees up money for the private sector, both individuals and businesses. The government has also indicated that they are going to reform the VAT. The objective is to remove certain levies, such as COVID levy. Now, that again will help to reduce the pressure on prices. Again, you can see that the objective would be to reduce pressure on prices. Note that the 2025 budget is not immediately removing the COVID levy, but it is planning to reform the VAT system, value-added tax system, which will ultimately remove the COVID levy and other measures. Ultimately, it will help to slow down the increase in prices and restore stability in the economy. Now, we also notice that the 2025 budget is proposing that the Ghana Stock Exchange will introduce market access tools, allowing investors, individuals specifically, to trade on the stock exchange using their phones. So that will make it easy for you and I to access the Ghana Stock Exchange and trade, buy and sell stocks listed on the market using our phones. Then the Bank of Ghana has been intervening on the market to ensure that the exchange rate, the CD, is stable. The 2025 budget has assured us that these Bank of Ghana interventions will continue to ensure that the stability of the exchange rate continues. One main driver of inflation, and this is the final point I'll be making on the 2025 budget, one main driver of inflation or higher prices on the market is food prices. Now, government through the 2025 budget is also intending to intervene in the agricultural sector, particularly food production, to ensure that the supply of certain important items like grains, vegetables, and poultry products, the supply increases. And once supply increases, then there's enough to meet available demand, and the pressure on prices will also go down. So essentially, this is our take on the 2025 budget. To summarize, the 2025 budget aims to restore stable prices, which will lead to lower interest rates because the risk to our investments would have gone down. And so the compensation for our investment will also, the compensation for risk to our investment will also go down, which is lower interest rates. And once stability has been returned or restored to the economy, then we can expect growth in the subsequent years. At this point, Abner, I would pause here and hand over to you for continuation. Thank you.
Thank you so much, Courage, for such an insightful discussion on the 2025 budget. And one of the things that I took out is that one of the main things the government is doing is to cut down government spending and to raise revenue without increasing taxes. And one of the key ways they are financing deficits is also using treasury bills as well. Right. Thank you so much for that. One key question I would like to ask is, how should investors position themselves given Ghana's economic outlook, based on what you have discussed with us today?
Sure. I mean, I started by mentioning the level of uncertainty in the global economy. And Ghana is part of this global economy. And this level of uncertainty means that investors must position themselves or their investment portfolios in a way that preserve a portion of their investment, that protects them from the uncertainty in the global economy. And so in your allocation of your investment funds, you want to consider assets that not just looks at growth, but also protects the value of your investment. I'm sure the portfolio managers and other presenters would give you detail of these kinds of assets. But one positioning would be to look at assets that protect your investments. Another thing would be to look at potential locking in of the interest rates we have right now. Because remember, I said the ultimate objective is to reduce inflation and bring down interest rates, as we have already seen on the market recently. Now, if interest rates are going to come down, it is appropriate to invest or hold investment instrument that pays high interest rates now and lock that interest rate, that high interest rate down until the future. Then you will redeem or liquidate that investment at a higher return.
All right, thank you so much, Courage. So for our participants on the call, please, if you have any questions for Mr. Courage concerning the 2025 budget or what the economic trends are currently, please put them on the Q&A session. We will be addressing them when we get to the Q&A part of today's call, and Mr. Courage will help us with responses accordingly. So thank you, Courage. We would move to the next speaker, and he is in the person of Mr. Herbert Denche. He's going to discuss or talk to us about the performance of the ICE Liquidity Fund and what the strategies are for 2025. So over to you, Mr. Herbert.
All right, thank you, Abna. I'm going to share my screen. Abna, please confirm if my screen is visible.
Yes, it is.
Okay. All right. Good morning, everyone, and welcome once again to this call. So this section is just to touch on the performance of the portfolio. How did we perform in 2024, and what's the plan and strategy is for 2025? So in terms of performance, we ended the year with a year-to-date return of 21.7%. Now, in 2024, there were three things that informed our strategy for the fund. The first bit is two key factors that were influencing uncertainty about the outlook. And those two things were elections and then the fact that we didn't have the full year budget being read to us. So the outlook for the economy wasn't exactly certain and sure. And so one of the things that we did with regards to the fund was to maintain a defensive approach up until we had clarity on how the elections were going to go and also getting some clarity on the budget. The other bit that also influenced our strategy was the volatile nature of interest rates. So we saw the early part of the year where interest rates were going up significantly higher. And then towards the later part of the year, we saw interest rates coming down a bit. And so again, with the volatility in those interest rates, we decided to again maintain a defensive approach. And then the last thing is on currency depreciation. So again, currency was volatile in 2024. And as part of our measures to ensure that the fund remains afloat in terms of performance, we included a US Treasury paper into the portfolio just to build some currency buffer. So these were the three things that informed how we position the portfolio and hence the return that we have for the year, which is 21.7%. I know it's common practice to compare the returns to Treasury bill rates, but again, we always look at a combination of these factors to ensure that we're always taking the best decisions for the fund. Now, looking at the next slide, we are looking at the maturity profile. And this is touching on how the fund looks like currently in terms of where we position across the curve. Now, we've seen interest rates significantly drop for the last 5 weeks. And so what we've gradually done is to rebalance about 15% of the portfolio across the longer end of the Treasury bill curve, which is something Courage has encouraged as we see interest rates continue to trend downwards. And this is in line with the new government's fiscal consolidation plan to ensure that they bring down borrowing costs and also bring down their debt profile. So we have about 15% of the portfolio in longer end Treasury bill papers, and we still have a greater part or a greater chunk of the portfolio in short-term fixed deposits and repos. Now, in terms of why we have the greater part of the portfolio still at the short end of the curve, this is looking at the net inflows in 2024. And this is something we pay a lot of attention to because the mandate of the fund is a liquidity fund to always ensure that once you make a redemption request, you are quickly honored, the obligation is quickly honored. So you look at the end of quarter numbers in terms of net contributions that came into the fund, and you realize that at the end of every quarter, we see significant outflows. And we believe this is just a seasonal effect from the institutional and retail side. And particularly in December, where we have the festive or Christmas season, we see a lot of redemptions, mainly because people would want to withdraw some of their funds, do something nice for themselves, buy something nice for someone. And so in managing the fund, we bear in mind or keep in mind all of these factors and the fact that once there are going to be redemption requests coming in at these particular moments across the year, we also position the fund such that we are always able to honor these obligations. And so it explains why we have a greater portion of the portfolio still at the short end of the curve. We are still monitoring and assessing how sustainable the decline in interest rates are, because the government is scrapping taxes and has planned to also reduce significantly in terms of their expenditure bucket. And so how sustainable and achievable these two things are is a question that remains to be answered. And so we are still monitoring how the sustainability of interest rates are going to decline. In the event that the government is unable to achieve all of the plans that are outlined in the budget, it is possible that interest rates could creep back upwards just quickly as they've come down, and mainly because the government is still using Treasury bills to finance the deficit. So we are not in a rush to quickly go long in terms of Treasury bills. We are still gradually rebalancing the portfolio to ensure that we don't jump the curve. The next slide is looking at our current asset allocation. So like I mentioned, we have a greater part in repos and fixed deposits. And then we've also slowly increased our positions in Treasury bills and rebalancing towards the longer end of the curve. On fixed deposits and repos, I think as interest rates have come down, one of the key things that is going to happen is the returns of the fund. We expect some decline in the returns, mainly because repos and fixed deposits are also being repriced by the banks that we deal with. So for repos and fixed deposits, they are short-term instruments. Repos are buy, sell back arrangements where we give the bank cash and then they give us Treasury bills. And then after a period of time, we buy back those Treasury bills at an interest rate. And fixed deposits are just placement where we give the bank cash and then they promise us a certain amount of return after a certain period. Now, these rates are being repriced because we've seen 91-day Treasury bill rates, 182-day, 364-day. All of these tenors have declined by about 1,000 basis points or 10% in nominal terms. So the banks are also repricing their repos and fixed deposit. So previously in 2024, you could get a repo around 23% for, let's say, 56 days. You could get a fixed deposit for 23% for 60 or 90 days. But currently, we are seeing banks now price some of these instruments between the ranges of 18 and 19%, and some are even pricing as low as 17%. So these developments are going to impact the performance of the fund. So don't be too scared or worried when you see a slight drop in the performance. Nonetheless, what we intend to do is to actively manage the Treasury portion of the portfolio to ensure that the returns still stay afloat. And secondly, we are also going to leverage our long-standing relationships with some of these banks to always ensure that we get competitive rates on the market. In terms of outlook, I think Courage has touched on it, but let me just recap. The government plans to embark on a very strong or stringent fiscal consolidation plan for the year. they are scrapping taxes, they are reducing the expenditure, and they are also reducing their borrowing cost. And the borrowing cost is what we are seeing being reflected in the Treasury bill rates, which have declined by 1,000 basis points. And again, what that means is that for a short-term repos and fixed deposits, they are also going to be repriced downwards. The second thing is we expect some activity on the new bonds, i.e. more trading activity on the new bonds as rates on the Treasury bills come down a bit. So what do I mean by this? Treasury bill rates in 2024 were trading around 23, 25, 27%. And then we had the new bonds, which are longer tenured papers or securities that have maturities of, let's say, 4 or 5 years, that were also trading around 20, 21%. Now, as an investor, you ask yourself, can I invest in something that will give me 23% in 3 months, or invest in the same thing that will give me 23%, but will mature in 4 years? And most people wouldn't pick the 4-year option because it means you're essentially locking your money for 4 years and getting the same rate as locking in your money for 3 months. And so that meant that investors weren't interested in trading new bonds. Now that we are seeing interest rates come down, what it means is that there's going to be now a renewed appetite for the new bonds because they become more attractive to trade as the interest rates on Treasury bills come down. So we're expecting some activity to pick up on the new bonds in the coming months. And then the last thing that we are also expecting, which is likely to happen, is the government minting some new bonds across the curve, preferably across the shorter end of the curve. So what essentially this means is that the government has new bonds that are all maturing in between 2027 and 2028, and then some maturing as long as 2038. But a bigger part of the maturities are concentrated in 2027 and 2028. What this means is that there's a high maturity risk that the government has at the moment. And so in order to reduce that risk, they want to spread the maturity across other parts of the curve. So they have some maturity in, let's say, 2 years, some in 3 years, some in 4 years, and some in 5 years, just so that it eases the pressure on them when they are repaying these bonds. And so we expect the government to come to the market and probably mint some of these new bonds across the shorter end of the curve. And finally, let me just recap the strategy. Like I mentioned, all the rates are coming down on Treasury bills. We are gradually rebalancing the portfolio to invest in the longer end of the Treasury bill curve. We are also going to leverage our relationships with the banks to ensure that despite the repricing downwards of repos and fixed deposits, we still get competitive rates on these instruments. And finally, what we also intend to do is to actively manage the Treasury portion of the portfolio. So as and when we see some opportunities to pick up securities that are mispriced, we would include those securities in the portfolio, and that should also keep the returns afloat. So at this point, I will bring my presentation to an end, and I will take questions. Thank you very much.
Thank you so much, Herbert, for providing us with these insights. One of the key takeaways I took is that with the Rice Liquidity Fund, we are maintaining our promise of keeping the fund liquid, so that we can meet our withdrawal needs at the 1 business day promise as we've given our clients. Also, repricing by banks may impact the performance of the fund, and we shouldn't be worried when we see that. We are actively managing our exposure to Treasury bill and also going to leverage our outstanding relationship with the bank so that we can secure competitive rates on fixed income and repos and to keep our interest rate at a fair rate. Thank you so much, Herbert. I do have a few questions to ask you, and one of them is what new market opportunities are we expecting in 2025 regards to the fund?
Okay, so in terms of new market opportunities, I think one of the things I mentioned was some activity creeping up in the new bond market. So that is something that we are keeping an eye on. We are not in any rush to buy new bonds for the portfolio at the moment, but it's an opportunity that is out there. When activity on the new bonds are up, what it means is that there's always going to be a mispricing of these securities. And if you can take advantage of this mispricing, once, let's say, you see a bond that is trading at a very, very high yield, then what it means is that the security is trading at a discount or the price is very low. And so you can buy such a bond, and then once the market corrects and reprices, you can secure some gains on that security. So it is one of the opportunities that we are looking out for and keeping an eye on. But again, we are not in any rush to include new bonds in the portfolio.
All right, thank you so much, Herbert. Please, if you have any further questions for Mr. Herbert concerning the performance of the fund and the strategies for 2025, kindly put them in the Q&A session of this Zoom call. We would address them when we get to that part accordingly. So Herbert, I'll come back to you when we get to the Q&A session, and we'll move to Mr. Allen. He is the head of global markets. He's going to talk to us about the Ghana Stock Exchange performance, and then what we should look out for in terms of stocks and ETFs as investors. So, Mr. Allen, over to you.
Thank you so much, Ms. Banda. Can you please confirm if you can hear me?
Yes, I can.
Thank you so much. So I'll keep it brief. I think Kara just touched on a few things that I'll also touch on. Essentially, we've had a lot of interest around the stock market. I think this is the stock market has had a 2-year positive run. Last year-to-date return was around 56%. The last time we had anything close to this percentile was in 2013. Post-GDP, when the bond market took a dive, some would argue that the stock market has held its own. A lot of this activity has been driven by MTN. And we've seen a resurgence of retail investors on the market, both a healthy mix of both institutional and retail. But if you look at the market, we've seen MTN has over 70% dividend payout. It's a great business, multiple streams of revenue. When you look at the performance of the stock market, there's also, when you look beyond the telco basket, especially the consumer and the financial, there is still quite some attractive opportunities on there. For the banks, we've seen post-GDP, I think a lot of people thought the banks are going to really have a tough run, but they have been resilient thus far. We've seen, I know a lot of talk has been around MTN, but if you look at GCB, they've had quite a run. SCB also came out, they gave paying dividends, which was sort of like a wake-up call to investors, those who are not looking at the banking basket. And then you have EGH, which also came in with the 80% year-to-date return. So beyond MTN, there is still quite some attractive upsides on the market. Well, and just to be honest, MTN has single-handedly sort of revived an investor posture when it comes to Ghana. We've seen a lot more retail participation on the market. And so there will be a lot new entrants into the market, and their entry into the market has been with MTN. That you can't deny. But as quote unquote, we're seeing scattered interest across the other baskets. For 2025, we still have we're tipping the banks to still have a cover, still have a run. I think there's still more room and leg run there for the banking basket. I've already mentioned GCB, the likes of SCB, and EcoBank. On the consumer basket, as investors are anticipating a more cooling inflation environment, we also are, I think if the city should have a more predictable run, investors are tipping the consumer basket to sort of have a decent recovery. We're seeing a healthy mix of products managing costs across board. And so investors are tipping this to pay off when we have a much favorable macro environment. Another key thing also with the stock markets, key shift has been the options for alternatives. Now, the stock exchange golden child, Opan, intended a new gold on the back of MTN has also been one of the most traded stocks on the market. It's had a stellar run both from institutional clients, investors, and retail clients. In 2025, we think that run is not going to stop. Geopolitical tensions still run. There's still a lot of uncertainty, as Courage mentioned. And so it's one of the, I think post-TDP, there's been a lot of reform in investment perspective, and it's been one of the things that has been highlighted in the conversations that we've had across the market. As Courage said, there's a lot of preference for store value and cover. So a lot of investors are looking to cover, a lot of investors are looking to hedge and to store value, and the new gold ETF presents quite a convenient avenue to do that. If you have any questions, I'm assuming I'm going to get the larger end of the stick with the questions, so I'll keep it short and have you ask me more questions.
Yes, we do have some questions, Aline, and thank you so much.
You're welcome.
So one of the things that we've heard about the exchange traded fund, we've heard about new gold, but we do not have a full understanding of what that is. Can you please break it down? What the new gold ETF is in simple terms, and how we can invest in that on our platform?
Okay, I'll take your cue and do it in the most simple term. So essentially, the new gold ETF is an exchange-traded fund. Unlike a mutual fund, it trades like a stock. And essentially, every unit is backed by an asset. And in this case, with new gold ETF, it's gold. So let me explain it like I'll explain it to a child. So essentially, every unit of gold represents a 100 troy ounce of gold. So a troy ounce, someone asked what the troy ounce of gold is. A troy ounce would be, I think, is around 31 grams. So essentially, the new gold, the ETF runs in the very, let me give you a visual. Let's say I give you a red ticket or a receipt that represents a unit of the gold, and you're able to trade that gold. Essentially, that's what the new gold ETF represents. So you are having exposure to an asset, but you don't get to keep that heavy and shiny thing under your bed. You basically just have a unit that represents your ownership of a quantity of gold. In this case, that 100 troy ounce of gold. And in the new gold ETF, you get to trade it on the stock market. So it trades just like a stock would. You get exposure to the dollar, which is priced in USD. I think the ETF was listed in 2012. And we saw it bounce back post-TDP when investors saw it as an avenue to store in value and also hedge against the other currencies. Essentially, we have a depreciation biased currency, so very sensitive to external shocks. But since the asset is backed by gold, which is priced in USD, it gives a cover. So for anyone asking what the ETF is, it's essentially exposing yourself to gold, but you don't get to keep the physical gold, but you get to also buy and sell whenever you want to. And just let me mention, another thing that makes people investors excited about ETF is ETF has an appointed market maker. Just to make it clear, IC is the official market maker in Ghana. What the market maker does is essentially to ensure liquidity. So unlike other stocks, we have to look for a buyer and seller. Your market maker is essentially your last resort. If you don't find a buyer or seller in the market, you get to face the market maker. So it sort of makes the issue of liquidity in our market quite an easy topic. And so investors like the fact that you can buy and go in and out of the stock as and when. And that's also one of the upsides of new gold. And also to mention, it's fairly cheaper than trading your traditional stocks.
All right, thank you so much, Aline. So for those of us on the call, if you want to invest in the Absa New Gold, the ticker symbol is GLD, which you find as part of the listed stocks. You can simply click on the buy button on the GLD ticker symbol and then place your order to invest in the absolute good. Now, Mr. Allen, one last question I will ask you before we move to our questions from our participants is, are there any major shifts expected on the Ghana Stock Exchange?
Ms. Panda, I would say I think the major shift for the market is the investor posture. We have seen a refreshed outlook on the market. As I've explained across baskets, there are a lot of attractive opportunities on the market. I think the one major thing that stands out is the alternatives. I think we're going to see a lot more exposure to alternatives, both across retail and institutional investors. I think a lot of concern is hedging throughout the year. We've had positive projection on currency performance and inflation, but we still see, however, a double cover in the ETF. Just so you know, because the asset is priced in dollar, there's a double cover there for those of us who have CD. So essentially, we've also seen that even when the price of gold dips, we find investors buying and still queuing in to buy because for them is a cheaper point of entry. So we think Q on Q, we are seeing a lot more interest in alternative. Hopefully on the back of this, we get to see more ETFs on the market, but for now, I think the investor posture is, you can say it's different from 2 years ago. We're seeing a portfolio which is prioritizing coverage and bracing itself for shocks. And I'm hoping that it cuts across both retail and institutional, and having more of a holistic view on the market than zeroing in on just return, as well as gold is doing. Just on the back, just aside from growth, investors are also seeing how much cover it gives them when we have shocks currency wise. So that will be mainly the shift of seeing the trading from a ticker that was listed in 2012, not having almost non-existent, to be one of the most highly traded tickers in the market. And it came in last year at 79% year-to-date return, which is quite huge, quite a stellar run. And it's still, gold just crossed the $3,000 price mark. And it looks like geopolitical tensions are not going anywhere. Central banks across are still stacking up on gold. And so we tip the interest in gold to sustain throughout the year.
All right, thank you so much. Yes, thank you so much, Alan. We do have lots of questions, which we'll be moving to right after here. I would be mentioning out the questions to our participants, but because of time, let's keep our answers very brief. But before I go ahead to put out the questions that we've received, I'd like to reiterate on the call that please, due to data protection and security, we are unable to provide individual or assist on individual issues or concerns on your various accounts. Please, we would need you to fill out our Google form link with your information so that we can reach out to you directly after the call. For CSE account creations, we are actively working on having all the accounts ready as soon as possible, and we sincerely apologize for the delay. So we'll move straight to the questions. I will start with Mr. Courage. So the first question I have here for you is, do you think some of the VAT reforms and increase of some taxes could neutralize the disposable income gains made by the taxes removed?
Thanks for the question, Abena. On the contrary, the VAT reforms, the VAT reforms, should rather support disposable income, because the objective of the VAT reforms is to remove certain taxes like the COVID levy. And once the COVID levy is removed, you know, it's 1% of the price of the item. Now, if an item is worth 100 cedis and you are charged a COVID levy of 1%, it means you are going to pay 101 cedis. But once the COVID levy is removed, assuming there are no other taxes now, once the COVID levy is removed, you're going to pay only 100 cedis. So that supports your disposable income further. So the objective of the VAT reforms is to remove certain taxes, merge some of the taxes, and reduce the negative impact on your disposable income. So it will not neutralize it, it will rather support it, the disposable income.
All right, thank you so much for that. The next question from Justice Wolanyo. So he wants to get insights on how the various elements in the budget will influence the various asset classes we have in our space.
Okay, so I will pick, say, fixed income assets. Fixed income assets are your treasury bills and your bonds and repos and your fixed deposits and co. These are investment instruments that earn interest. Now, the objective of the 2025 budget is to reduce inflation. And on the back of that, future lower inflation, reduce interest rates today, so that by the time when you buy the investment instrument like a T-bill today, the interest rates you are likely to earn, and you have seen that interest rates are coming down. So the impact of that will be that interest rate on your investment is coming down. But it is because by the time that investment matures in the future, the expectation is that inflation will be lower than where it is today. So you are still left with some positive returns. So the impact of the 2025 budget is to bring down interest rates, but it would have brought down inflation in the future, so that the interest you are earning will still be compensatory for the inflation risk.
All right, thank you very much, Courage. Another question for you before I move to other participants. The 2025 budget is deflationary. However, how does this hedge against the long-term risks such as delayed spending and possible lower corporate profits? This question came from NKKB.
Right, NKKB, thanks for the question. And I think it's important to clarify that deflation is when actual prices are going down. But that is not the intention of the budget. What the budget is trying to do is to reduce inflation. And when there is a reduction in inflation, actual prices are not going down. It is the rate of increase in actual prices that is slowing down, that is coming down. Let's take, for instance, assuming I am priced and I'm running very fast, and then suddenly I start to jog. Now, I am not going as fast as I was running because I'm just jogging right now, but I am still going forward in the process of jogging. Prices will still be rising when inflation comes down, but they will be going up slowly. So the objective of the budget is to ensure that prices still go up, because prices need to go up to entice producers to produce, but they'll be going up slowly. Now, in the short term, the activities that will be done to allow that to happen will have negative impact on economic activities. So you see that growth will slow, the economic growth will reduce in 2025, expected to reduce in 2025. But every businessman and individual wants a stable economy. So once that is achieved, it is a trade-off. So we are sacrificing growth today to achieve stability. Once that stability has been restored, everybody is confident, they can then release their capital for long-term investments. And that release of capital for long-term investments will make growth, economic growth, and disposable income start to rebound again. So that's the objective of the 2025 budgets.
Thank you for the clarification, Courage. The next question goes to Mr. Herbert. This is from Elvis. I see there's currently about a 2% allocation to the US Treasuries. Do you have plans to increase this exposure? And what's the target exposure? What will actually drive this decision?
Hi, thanks for the question. So in terms of the US Treasury allocation, we ran some scenarios on the portfolio, and the purpose of the scenario was to look at the possible impact on performance, assuming that currency doesn't depreciate as much as we expect. And based on the scenario analysis that we ran, we think a maximum of 2.5% allocation ensures that in the event that currency doesn't depreciate and even appreciate much than we anticipate, it doesn't significantly impact the performance of the fund. So we have a target and max allocation of 2.5%, which is what we have currently in the portfolio. But this is not the market is flexible, it's evolving as well. So we might increase this allocation if it becomes necessary. But for now, the target maximum allocation is 2.5%.
All right, thank you so much, Herbert. The next question goes to Mr. Allen. This question came from McLean Dupuy. He wants to know, what's your outlook on ETI and CAL for the year?
ETI and CAL, I would say this across board, we've seen a lot more capital retention strategies for the banks. I think it's basically trying to, I would say, get a better asset quality. So both for CAL and ETI, we see that across. And like I said, the banking basket has been resilient. We see a lot of attractive opportunities on there. I may not be able to give you a detailed percentage on where we see the upsides, but looking at what investors are doing, I think a lot more people are latching on to basically placing their bets on the banking basket. On who we've picked for the year, both CAL and ETI are not on that list. But I think if you do take a closer look, we might see a resurgence on the banking basket. I wouldn't say year to date we might see on the ground value wise, but price wise, we've already seen CAL having a rally. That means the investors have confidence in it, both with ETI and CAL Bank.
Okay, Mr. Allen, thank you so much for the insight. The next question also goes to you. This came from Mr. Edem Blebu. He says, I'm curious about which industries or companies within the GSE which are in the position for breakout growth in 2025. And are there any indicators investors should look out for, example, trading volume or government intervention?
Sorry, can you repeat that? I don't think I got the ending part of that question.
Okay. So which industries or companies within the Ghana Stock Exchange are in the position for breakout growth in 2025? And are there any indicators investors should look out for? So example is trading volume or government intervention.
In terms of which sectors, industries I think will be a breakout, as I've already mentioned. I think the consumer basket for one, as Kai's already tipped, if we do see a more predictable city and have a more cooler inflation environment, we still see some purchasing power. And I think when that happens, we will see that top lines for these consumer industries would improve. We've already seen UNIL have a great run. UNIL posted a decline in profits, but it was rewarded with the rally in price. And that shows you that investors are looking at how these companies are managing, basically managing through these macro challenges. They're looking at how they're managing costs, their product mix, and how they're engaging. And so I think they are poised to make a recovery, a more decent recovery when we have a favorable inflation, as we've already projected a favorable inflation rate. Once that sticks through, we will see quite a recovery in the consumer basket.
Okay,
and also to mention, the basket would be the financial basket. Like I said, we're still seeing a lot of demand, interest in SCB GCB, SCB came out paying dividends. That's quite a favorite for investors. And so there's still a lot more upside in the banking basket if you actually take a look at these tickets.
All right, thank you. I hope
You're
your
welcome.
your question has been answered, Mr. Edem. So I'll move to the next question, which is directed to Courage. You seem to have a lot of questions for Courage. So this is from Mr. Vincent Sello. Seeing that Treasury bills has actually dropped from around 27% to about 14 and 15% in the last few days, would you encourage me to still invest in Treasury bills, or would you rather advise me to consider investing in BOG Gold coin, and what are the implications?
Well, I think that the decision to invest requires a lot more detailed consideration. You need to check your risk appetite. You need to check your investment horizon. Essentially, what I'm trying to say is that it is not enough based on just the reduction in T-bill rate at the moment to advise a client to buy A or B. We need to discuss a lot further. And I guess we could have this conversation, go reach out to us, and we could have further discussions to understand the investment objective, the risk appetite, and the investment horizon. I mean, how long it plans to do the investment. Having said that, the reduction in T-bill rates also, how I want us to see it also is to see the current T-bill rate in the light of future inflation. So, for instance, the rate on the 364-day paper currently is 19%, and inflation is currently at 23%. And one would say that's a net loss of 4%. However, that 19% you are expected to earn on the 364-day, that's 1 year from now. By the time you redeem that 364-day and earn the 19%, question is, will inflation still be at 23% or it will be much lower than 19%? The expectation by the government, and in our view, is that 1 year from now, inflation will be much lower than 19%. So it is actually a net gain by the time you are redeeming that 364-day paper or that investment. So the current lower T-bill rates is pricing in future lower expected inflation. And so that is essentially why we have the government pushing down interest rates as fast as they are. So current T-bill investment may not be a total loss to investors as things stand, given the lower future inflation. I hope that helps to answer the question.
Hello, ladies and gentlemen. I think Ms. Bando's, I think the Bando's channel is frozen. If anyone has any questions, I'm more than happy to host this going forward.
All right, thank you so much, Ali, for holding the fort.
Oh, you're back. Thank God. Thank you.
Yes, I'm back. I'm back. All right. So thank you all so much once again for joining us on the Zoom call, and also to our YouTube viewers. We see you and we appreciate you for joining us for today's call as well. Due to time, we will allow a few more questions And so I would go back to Mr. Herbert. Okay, I have a question for you here. So the question says, government mentions a re-entry to the bond market this year. As analysts, when do you foresee a bond issuance, and what signals should the government send to make before such issue?
Hi, Abner. Thanks for the question. Could you kindly repeat the last bit?
Sure, I'll do that for you. So, as analysts, when do you foresee a bond issuance, and what signals should the government send to make before such issuance?
Okay, so in terms of timelines, to be honest, we wouldn't be able to give exact timelines on when the government plans to come to the market. But what they do is they do put out a communique and share it with the primary dealers to let the market know that they are coming to issue new bonds. They give the indicative rates, which is usually described as the initial pricing guidance. So I believe what the government is also keeping a key eye on is how interest rates and how inflation evolves over the year. And like I just mentioned, once we see inflation decline and approach the target rates that the Bank of Ghana is aiming for, it might be an ideal time for the government to consider minting these new bonds. But in terms of exact timelines, I wouldn't be able to give you exact timelines.
All right, thank you so much, Herbert. Unfortunately, we would have to bring our questions to a close due to time. And so we'll move to the next session of our presentation today, where we would talk about upcoming initiatives and future plans that we have. So we do have a mobile app, both on the Android and the iOS. The name of the app is ICWell. We do have new updates on the app, and so we'll encourage everyone on the call to download the latest version of the app. If you're having difficulties doing that, you can delete and reinstall the app once again. And I would also go ahead to address some of the concerns that we've had on the call, which is the CSE account creation delay and timeline. So typically, once you complete registration on our platform, it goes through three major reviews. The first is the internal review. So our compliance team will go through your account details to ensure that the information provided meets the minimum KYC requirements by our regulator. So we are regulated by the Securities Exchange Commission, and they do have certain requirements that we are supposed to meet. Okay. So once we have received all the needed information, our compliance team will review and approve your account, and then we move to the final stage, which is the CSE account creation. Now we create your account on the CSE system. Okay, and it has to be approved by the CSE. Now the CSE is a central securities depository. You need that account to be able to trade. Okay. Now, at that point, we do not have control over how long the account will be approved by the CSD, but we do constantly follow up once we realize that there has been certain delays on it. Now, these are the processes we go through before an account is approved for trading. Now, we do understand that some accounts have been pending for quite some time now, and our team is actively working on having all accounts approved for you. Now, for those who CSD are outstanding, okay, we can expedite the process for you if you have an existing CSD ID. Now, if you have purchased Treasury bill in the past with a bank or an institution, or you've purchased shares with any other brokerage firm, you may have a CSD account. Now, we would need you all to please reach out to the institutions, the bank, or the other brokerage firms for your existing CSD ID and provide it to us. Now, we've put out our Google form link in the comment section of the Zoom call and also on the YouTube channel. please pick up the link. Once you get your existing CSA ID, you provide those details for us on the form so that we can expedite the process and have your account set up ready as soon as possible. Okay. Now, another thing I would want to also point out is if you have an existing CSA ID, we can register for you. We will need your bank details. Now, there are some who completed registration with their mobile money number as payment. We would need you to go back onto the app. So once you open the app, there's a three line on the right-hand side of the app. You click on that, and then you go to profile information. Once you go to profile information, you select bank account information. And over there, you'll be allowed to add your bank details. We need your bank details to register for your existing CSA ID. So immediately you complete the Google form link with your existing CSA ID, please check to ensure we have your bank details so that we can expedite the CSA account process for you and have it ready so that you can have a seamless trading experience with us. So thank you so much for your patience. We really do appreciate it. And we will take our key takeaways from our participants, starting with Alan. We'll move to Mr. Courage and then Herbert. So Alan, please give us a summary or key takeaways of your presentation.
Thank you, Ms. Bando. I think the key takeaway from my end will be for investors to adopt a more holistic approach into investing. It's very inspiring to see just how much trading activities coming from the retail section. Most of these investors are coming through NTN, which is very much understood. But I think the idea is to have a holistic look at the Ghana Stock Exchange. There's a lot more attractive opportunities outside the telco giant, especially within the banking and consumer basket. And then on the back of that will be to have a more open outlook into alternatives. I think I'll always say this, understanding how a business works makes it so much easier to invest in. And I think there's quite some great businesses on the Ghana Stock Exchange that investors can expose themselves to. Also, so that will be the key takeaway from my end.
Right. I think that's Mr. Courage.
Right. For me, the key takeaway would be that we are all expecting more stable or better stable prices in 2025. We are all expecting that whatever the authorities do here, I mean, the government and the central bank, whatever policy they roll out, it will be aimed at restoring stable prices. And once that stable prices is achieved, interest rates will come down. So that's the key takeaway. The other takeaway is that the declining interest rates we are seeing right now on the market is actually based on the expectation of lower inflation or stable prices by the time these T-bills mature. And that is why the authorities are driving down interest rates. And so we need not necessarily see the lower interest rate today and consider it as a net loss being recorded on investment. Finally, the global economy, and for that matter, even emerging economy like Ghana, is confronted with a high level of uncertainty. And given the level of uncertainty that we have in the market, there's always the need to hold a certain portion of your investment in defensive assets, as the fund managers are doing. And based on this, we should continue to trust our fund managers to take the decisions that are in our best interest. Thank you very much, Abna, and happy to hand over to you.
All right, thank you so much, Courage. Mr. Herbert.
Yes, so I think I'll just piggyback on what Courage touched on, which is the expectation for inflation at the end of this year vis-a-vis where we have currently the treasury bill rates. And so, like I mentioned in my presentation, there's no need to panic, especially as we're seeing these sharp declines, because once we see inflation also decline across in the next six to 8 months, you realize that on the net real return basis, you're still better off. And so there's no need to be so worried that we are seeing a sharp decline in interest rates. The other thing that I would encourage everyone on the call is to ensure that you invest in what you understand. So there's a lot of volatility across fixed income in Ghana. There's a lot of volatility on global equities. And a lot of you might be wondering, what do I do with my money? Interest rates are coming down. I need higher returns. I want to go and buy the Bank of Ghana gold coin. I want to do this. But I think in these moments, it is essential you remain calm and you invest in something that you understand. And in the event that you want to invest in something that you probably don't understand, it's recommended that you speak to a trusted investment advisor to get a better understanding of whatever asset class you wish to invest in. So I would highly encourage everyone on this call not to panic so much in these volatile moments and to ensure that you invest in only what you understand. Thank you.
Thank you so much, Herbert, and all our speakers for today. We really do appreciate the information and the insights that you've given to us. And thank you so much to our participants, both on the Zoom call and the YouTube. We really, really do appreciate taking your time off your busy schedules to join us today for us to have this important discussion. And I do believe that the session today was very informative and insightful. And we did take away a few things that would help us to make informed investment decisions for this year. We are going to provide recordings for this call on our YouTube page. Once it is ready, we'll send out emails to all our participants so that if you would want to go back to watch, it will be available for you. For our new clients on the call, we do have investor call every quarter where we have the opportunity to meet with the fund managers and also to have a discussion, ask all your questions that you may have. And yeah, so I would also like to iterate that you can always reach out to us via phone, WhatsApp, and email. Our phone number is 0308 250051, and our WhatsApp number is 055 255 7789. If you'd like to reach out to us via email, our email address is clientservice@ic.africa. And for those who want to visit us at our office, we are located at Accra, North Ridge. We are close to Alisa Hotel. You can input IC securities into your Google Map, Bolt, Uber, and it will bring you straight to our office. Right. So we'd like to say thank you so much once again. All too soon, we've come to the end of today's session, and we will keep all our investors and participants informed of any future updates via email, WhatsApp, calls, and we do appreciate you joining us today. So thank you so much for joining, and this is bye-bye for now. Have the best rest of the day. Goodbye.
Why you need a CSD account before you can start trading stocks. If you're ready to embark on your investment journey, this is a crucial step you can't skip. CSD stands for Central Securities Depository. It's a digital account where your stocks and fixed income securities like T-bills are held in electronic form. Think of it as a bank account, but instead of holding money, it holds your stock and T-bill investments. A CSD account ensures that your stocks are safely stored in a digital format in your own name. No more worrying about losing physical certificates or receiving physical dividend warrants through the post. Everything is electronically recorded and protected. With a CSD account, buying and selling stocks becomes much faster. You can execute trades in real time, and dividends are paid directly into your bank or mobile money account. Having your personal CSD account is a legal requirement in many countries, including ours. It ensures that all your trading activities are transparent and comply with the regulations set by the securities market authorities. Why you need a
I see an Africa that's focused on the things that I see an Africa that's focused on the things that are affecting her people. I see Africa going global, making her mark on the world stage. I see Africa's innovation, showing excellence in all she does. I see Africa getting wealthy. I see Africa I see Africa. I see an Africa that's focused on the things that are affecting her people. I see Africa going global, making her mark on the world stage. I see Africa's innovation, showing excellence in all she does. I see Africa getting wealthy. I see Africa. I see Africa. I see an Africa that's focused. I see Africa. I see Africa. I see an Africa that's global. I see Africa. I see Africa. I see Africa. I see an Africa that's focused on the things that are affecting her people. I see Africa going global, making her mark on the world stage. I see Africa's innovation, showing excellence in all she does. I see Africa getting wealthy. I see Africa.